Here we go. Okay, so let me say that again. I know this is a QQQ, and it's on the 250 range QQQ, and what I was saying was, at the end of the day, when the option markets close, before the option markets close, if you come and look at these, like the QQQ and the SPY, or any stocks that you want to look at, you guys know that when you come out of the overbought or the oversold, and you're with the trend, that price is trying to get to the prior swing high or low, right? So, if you look at that, and in this case you would buy puts, listen to Ronnie, in this case you would buy puts, the strike price, you're expecting to get down here, right? The strike price, so the strike price somewhere before that, so the 478s is what I was looking at. And what I was telling Chris last night is if you see that at the end of the day, and you buy that, usually first thing in the morning, a lot of times you'll have a gap down, because this is what the market was doing at the end of the session. And overnight, the European markets are open, the Asian markets are open and all that. By the time the US markets open up, usually you're going to see that drop down. And this is what I was looking at last night. I was applying this right here. I was applying the diamond principle to it. When it does exceed this level, it didn't actually exceed that level. It got down to that level, but didn't exceed it. So the diamond principle doesn't apply yet. But this is what we were looking at yesterday. And I was saying, if you're not greedy with your options, and if you say you buy it, and yesterday it didn't look like anything you would want to buy, because yesterday, when at the end of the day the options were up 130%, right here at this point in time, they're up 130%, and didn't look like anything that you'd want to buy. But what the charts were saying was that it's likely that it's quickly, when the open happens, going to get down to the prior swing low. And if it does get down to the prior swing low, and you bought 78s, the 78 puts, the prior swing low is a little below that, so you'd be in the money on the 78 puts. So the chances are that you'd have different I mean, you'd have a great gain on that. And what I was saying last night, they closed at 302 yesterday, and that's what I was showing earlier. Hang on, let me bring it up and I'll show you what I mean. This right here is what I was showing earlier. This is what it closed at yesterday, and the puts were at 302. And I said, if you bought the 302s yesterday, and you could have probably bought them right at 3. There's a little bit of a spread. You could have bought them at 3. The 478 puts at 302 with a target of 4. I said at the open, I think it's going to get down to this level at the open, and you'll see $4 on the puts. You'll see a $4 value on the puts, and that, my friends, is exactly what happened right there. All right. So I said if you were to put a target. If you were to put a target of $4 on those puts, when you buy it, put a target on the puts. Don't be greedy. Don't try to hit a home run on every one of these things. If you can take 25 to 50% out of a trade consistently, when you trade in options like this, that you got a winning formula, and you should work with that. And this is something that you can do. This is something that all you guys can do. If you want to get away from futures a little bit, this is another avenue that you guys can use using the TV Trades range trigger. Now, you're going to want to have the TV Trades range trigger in your toolbox, and you're only going to have that in your toolbox if you're a passport guy. But you'd be able to do that, in the after hours, or like in the afternoon, 2 or 3 o'clock in the afternoon. If you go around and you look at things like this, not just this, but if you look at all the equities, like everything that's closing at 4 o'clock, when the stock market closes. Look at Tesla, look at Intel, look at AMD, look at Mister, look at all the ones that are fast movers. Look at where they're closing, and if they're closing with the trend coming out of the overbought or oversold, to check the options on those, because there's a good chance that the next morning you would get a 25 to 30% gain right at the open, and that's exactly what happened here. All right. So the TV Trades range trigger, that was part of the TV Trades range trigger. That's what's in the lesson plan for today. All right, let me just say, lesson plan for today is day 3. I have leg lengths and a TV Trades range trigger. Now, in me saying all that stuff to you, I just covered both of those things. Because what do you expect when you have a leg length? Right? The markets are always doing the same thing, and they're doing the same thing with the QQQ as they are with all the futures. It's all the same stuff. Okay, it's always all the same stuff. So in here, you know, the market's always going up and down, right? Up and down, up and down, up and down like that. And it's the same thing with the QQQ. It went down, it came up, it went down, it came up. And how far do you expect it to pull back? I expect it to pull back 50%, right? And what do you expect to do after? You expect to do this leg length again. That leg length again would put it right down here. All right, that's why I drew that yesterday when I was in that meeting with Chris. This is what we were talking about. I don't know how I got off on this tangent yesterday. I think, oh, I know how. She asked me. And I want to just say that to you guys. If you have questions that may seem a little off, you know, especially if you're in a one-on-one with me, if you have a question that's not futures related, that you may seem that you may think is a little off topic, ask it anyway, because I don't know. If I know, I may have like a whole bundle of knowledge that's untapped that I can tell you that will benefit everybody, because I, you know, there are things that I have up here in my noggin that I don't know about until you actually ask the question and you pick my brain. And this is one of those things yesterday when Chris asked me to look at the bigger time frame stuff outside of futures. She didn't exactly word it like that, but that's kind of what she was asking for, right? And so this is all the same stuff, right, with the ETFs and with stocks too. The stocks, you expect the same things, right? And this is on the 250 range. Chris, you would ask something, how do I decide what range to use for the ETFs? The range that I use is based upon the price. All right, if it's really high price, like, you know, something that's over $100, you probably want to use something more than 100 range, because what these are, 250 range, when you're talking about stocks or ETFs, is 250 cents. Every move up and down is 1 cent. So it's 250 cents. So every bar is $2.50. Okay. So that's how I look at it, Chris. If it's a high price stock, then I'm going to look for a higher range. Like the other day, I'm trying to remember. Well, anyway, the other day I was asked about Bitcoin, and on Bitcoin, sorry, let me get back to, let's delete that first. On Bitcoin, because it's so high priced on Bitcoin, sorry, let's just go to Bitcoin for a second. Bitcoin, because Bitcoin is, why am I doing that? I don't mean to do that. Sorry, I don't mean Bitcoin futures. I want this one right here, Bitcoin US dollar. Because Bitcoin is so high priced, you know, if you do that here on a 10,000 range, then every bar in here on a 10,000 range on Bitcoin should be 61.5 down to 16. Every bar is $100, right? Every bar is $100 on the 10,000 range, and it's, you know, it's easier to deal with, right? You could do it on a much smaller time frame than a 10,000 range, but you'd be looking at a ton of bars, and they're not going to be all that meaningful. But right now, you can see with Bitcoin, the same stuff works, right? Everything's up, you come onto the oversold, it kept going up. Everything's up, you come onto the oversold, it kept going up. Prior swing high got hit, came back down, didn't give you another trade because the ribbon wasn't right. Give you a short right here, didn't put in a lower swing yet. So, but all the same stuff works. But it's based upon how big, what the dollar value is of the actual underlying security, Chris. Okay. Let me bump this back down to the 250 range, and we'll go back here to the QQQ. Okay. So back in here, all the stuff that I was saying about this needs to put in a lower swing, but it didn't. It got down to the prior swing low and it hit $4, which is exactly what I thought it was going to do. Now, if it were to go through it and come down to here, you know, we're racing against the clock now. All right, it's Wednesday, well, Wednesday morning, and the options expire on Friday. So one of the things that I was showing to Chris, because not everybody wants to spend the money on the options and the prices of the options and all that stuff. Let me open up something else that I have here. I think I have something else open here. I do. This right here. All right. So this is where they were, pre-market today. This is where they were, the 78s, 78 puts. They were 296. What that means is you move the decimal place over twice. It's $296 for one option. Okay, just move that decimal place over twice. Now this is pretty close to the money. The 78s are pretty close to the money. Usually the best priced as far as the Greeks go. For me, I think the best priced one, the best one that moves best with price, is 2 out of the money. This is a little more than 2 out of the money, but it was pretty close to 2 out of the money. But you see, that's what it was up yesterday. It was up 130% yesterday, so it's kind of tough to want to buy it when it's already up 130%, right? 302 closed yesterday. That's what I was talking about earlier. It's kind of tough to want to buy it when it's there, but given the information that you have based upon what you know happens again and again and again when you have this kind of a situation where it pops out of the overbought, the ribbon spread, and you're right here, it usually goes down to the prior swing low, right? It would usually go to the prior swing low, at least to the prior swing low. So that gives you an edge. That gives you an opportunity that you can get into and take advantage of pretty easily. And that happens again and again and again. And it's not just on the ETFs. It's on stocks. It's on everything. Now the futures, they run all the time, so you can't really do this with the futures. I mean, well, you can, but we trade the futures this way. You can't do the options on the futures this way. Playing the gap thing, I mean, from the open to the close to the open. Anyway, I just wanted to show you guys all that. So let me take a breath for a second here. And the thing that in the lesson plan, let me bring it back up. So we had leg lengths and TV trades range trigger. Now, let's talk about the range trigger a little bit. I know that there's some question about all these different things that we have going on down here, all the potential different things that we have going on, right? This slingshot down here is what NinjaTrader and DT Pro have. Okay. TradingView has the ultimate slingshot, this and this. DT Pro and NinjaTrader only have this. The TV Trades range trigger is only available on TradingView, and it's only available, full time to Passport people. If you're not Passport, if you're just mentoring, then you can watch it for 2 hours in here in the morning. But you're not going to be able. You only be able to watch whatever chart I'm showing. During the lesson plan like this, you're not really going to be able to watch it all that much because I'm going to be jumping around and showing different things. But you have to watch it in here, and then in the afternoon from 1 to 1:30 every day, I do another live stream where I trade again for another half an hour every day. To get into that, you have to get into the next session. I'll show you how to do that. But I do that every day too, and we've been doing that every day for, I don't know, all year, I think, so far. And so you have it available to you for those 2.5 hours a day if you're not Passport. If you are Passport, then you get access to it all the time. It is not the same as the ultimate slingshot. You get a lot of the triggers will be in the same place a lot of the times, but they're clearly not the same. Okay, like right here, this one right here, this false one. No, that wasn't the false one. It was bullish. But like right here, you see how it came out of the oversold right there. It wasn't even in the oversold there. A lot of them they'll trigger around the same time, but they're not the same. They're not even close to the same, and the math that goes into them is completely different. And you have the old slingshot. Now the old slingshot was a workhorse, and it does a lot of things. I know some of you guys have things that it does built into your lesson plan, and if that's working for you, then don't change a thing. All right. If anything is working for you consistently, then don't change a thing. But for everybody else that's not being consistently profitable, or that wants to try something else that is working better, more consistently, and more frequently, then look at this. Okay. When I say better, I mean easier, because this ultimate slingshot, the ultimate slingshot, ultimately, pun totally intended, was responsible for putting the arrows on the chart. Right? That was its one function, was to put the arrows on the chart. We're not showing any arrows on the chart anymore, so we're not using the ultimate slingshot anymore. Okay. And the excuse me, the TV trades range trigger, it is a culmination of a lot of different things, and it's just made everything so much better and easier to do, where we can just use this for our trend. We don't need to have the context colors, we don't need to have the outer bands, we don't need to have short-term and long-term outer bands, we don't need to have all that stuff, because we can use this for our range. It's more reactive than the outer bands were. We use this for our trend, and this for our entry, right? So the TV trades range trigger is the final thing that's going to get you into the trade. It's got to pop out of the overbought or oversold for the trade to happen, right? The other things that need to happen, you always have to have a higher or lower swing. Step one. All trades must come after a higher or lower swing. All right. And in here for the long trade, Daniel, I don't know if you're still watching right now, but remember this used to be about 3 lines, and it wasn't. Even the 3 lines didn't have all the information in it. We're now down to 1 line that does have all the information in it. Okay. And the risk management stuff in here. I think, Daniel, the last time you were in here, we were on a 15 range for the 15 range for the NQ, and we're still on 7 range across all the other markets. So I changed all the other markets to a 19 range. Well, I left the ES alone because ES didn't change that much in volatility, but the other ones have enough volatility. The Russell and the YM have enough volatility to trade a 19 range. And I'm using a 25 stop that trails to break even after 10 ticks in profit for those two. And with the NQ, I have a 36 by 48 bracket. Alright, so a lot of times I hit that 48 target on it. Is a TIQ slingshot the same as the NT8? Yeah. You're talking about this one right here, Chris, right? This one. That is the same as NinjaTrader and DT Pro. Okay. Alright, so I was going through the rules because I just want to make sure, oops, the rules. You understand that this is how simple it is now. You gotta have the higher swing, all lines in the ribbon are visible, and then the final thing to make it a trade is the cross. Alright, that's it. The rest of the stuff is as you see it right here. The trade exit is still the same as it always was. This stuff right here, that was always the number one thing. And this stuff right here, the numbers changed a little bit. You know, I added a couple of numbers in there. I added the 19 and the 31, and I changed. I added the 11 in there as well. But the 4 and the 7 stayed the same. But so all that stuff is there for you to see and use if you need to. And that's that. Let me. I want to save this screenshot right here. Okay. All right. So let's jump back toward the futures with this. Okay. Now, things that we had in the lesson plan for today. Well, there's a couple of things that I want to show you because I did have that question. I think Chris had asked that question last night in the meeting too. Or it might have not been Chris in the last meeting. It might have been the day before in the meeting that I was in. There was a question about the 100 range, right? Because I think I said it in a partners meeting. if you take the 100 range like this, right, and with the 100 range, almost any time it comes out of the overbought, the oversold with the trend, you're going to have a decent trade, right? And what I was saying is the size of the stop, and Chris, this probably is something that you were wondering about. When you jump to the larger time frames like that, how big should your stop be, right? If I jump to a 250 range or 100 range or something like that, how big should the stop be? Hang on a sec. I'm going to take a drink and I'll get right back to that. Alright, so when you when you jump to a larger time frame, let's look at what we have in here on the trade rules. All right. So a 4-tick range has an 8-tick stop. So the range bar has a stop that is twice the size of the range bar. All right. A 7-tick range has a 10-tick stop. So the bigger the range bar, proportionally, the smaller the stop is going to be. All right. The 11-tick has a 15 range bar. Again, proportionally, the smaller the stop. This is 3 ticks bigger than a 7 range bar. This is 4 ticks bigger. Percentage-wise, this is almost 50% of the range bar size, and this is a little over 30% of the range bar size. This is 200% of the range bar size. And the bigger you get, this is 25% of the range bar size. This is, well, it's pretty close to that. It's about 20% of the range bar size. And the bigger you get, this is, I'm trying to do the math in my head. I'm sorry, my brain is stuck, but it's like 18%, something like that, of the range bar size. And the bigger you get, the smaller it's going to be. Like 100 range, I would use 110 stop. Okay, and I know that if you're trading the NQ, 110 stop is $550. That's a lot of money with one contract. It's a lot more money to have 10 contracts on. But if you switch to the micros, MNQ, if you switch to the micros, you have the same great trade setup, the same great entry, the same amount of movement that you should get out of the trade. But if you trade, it takes 10 micros to make the equivalent of one regular NQ, one mini NQ. So if you only want to risk, say, $100, then only trade 2 micros. You're going to risk $110 if you trade 2 micros. Okay, you have the same trade setup, the same long entry that you get into, and you'd be holding on to it for a while. You're not jumping in and out of trades like we do in the room in the morning. If you want to get into something and hold on to it for a little while, you can do this, and you can set this up so you have an alert that lets you know, when it's gotten into the oversold. So like the down close of this bar right here that put it into the oversold, you can have an alert that lets you know that you've gone into the oversold, so you can get ready for the up close on the next bar. All right, and so if you know what the low of the next bar is, however long it takes this next bar to trigger, it took 2 minutes for that next bar, 2.5 minutes for that bar to form. So you had 2.5 minutes from the time that this bar closed, and you would have gotten an alert that said, okay, we're in the oversold. You had 2.5 minutes to look at your charts and say, okay, well, I can see that the up close of this is going to be here, and you put your buy stop limit one above it. Right? So you have plenty of time to work with this if you're using the larger time frame like that. And if you're using 2 micros, then you're only going to risk $110 on the thing. And your anticipation is that it's going to get up to the prior swing high at the very minimum. That's going to get up to the prior swing high, and then up to the high before that. And if you put on the table right here, these are the levels that the table was given 20,011, 20,080, 20,324. So we're getting up to the 80 right now. The 80 is up here. We hit the 11, which was right here, right? Wasn't this the 2011? Yeah, this was the 2011 one. So within the table, you have your first longer target is right here. And if you get into that trade on 100 range, a lot of times those targets in there are going to get hit. You would have had to hold on to it for a while. You would have gotten into that right here, the close of that bar, which would have been the open of this bar at 10:08. So from 10:08, it took until all the way up here at 10:19. You would have held it for 10 minutes. 10 minutes. And how much would you have made? From, let's say you got in at 54. Let's say you got in at 55. And it ran all the way up. 9:55 you got in, right? 9:55, and it ran all the way up here to, let's just say it ran to 20,010. That's what, 55 points. 55 points. 55 times 4 is 220. So that's $220 you would have had right there. 220 bucks. Right? Because you had two contracts on. So in that 10-minute move right there, you would have $220. And then you could have done it again right here. The same thing all over again from right here. And this one went 970 and it ran all the way up to 50. So you have another 55 points right there. Another 210 bucks right there. Or 220 bucks. You see what I'm talking about? If you go to the larger time frame and you don't want to risk a lot of money, you can use the micros. Because the micro markets now are more liquid than the mini markets. 2 years ago the micro markets kind of sucked because there was a spread and the commissions were so high, but now the commissions are down, and it's 50 cents for a micro now. So it's almost the equivalent of trading a regular futures contract. If you trade a bunch of micros, it works out to be almost the same. So I think they probably realized that, the brokers probably realized that nobody's going to trade the micros if the commissions don't come down. So they kind of made it about the same as trading a bunch of micros as trading one mini. So the commission part of it's not an issue anymore. If it wasn't an issue with the minis, it's not going to be an issue with the micros. Is the way they made it. At least at my broker. Not all brokers are like that, I know, but my broker made big changes because they used to be one of the ones in the beginning. They're charging just about the same for a micro. $3.50 for a micro, and that was more than some people were paying for the mini. But for those of you guys who don't know, StoneX changed their whole price structure, and they have a price structure on their website now, where before it was kind of like a random price structure that different brokers charge for different levels of service and what they consider different levels of service and all that. But now they have a standardized price structure on their website, and even the minis are down where everybody else is, even lower. Just saying that, Daniel, if you're still in here, I don't know if you're still in here, but I know that you've been going back and forth and you didn't like the commissions and even the delay that you were having with StoneX. I know that was an issue for you too. But the commissions have come down. So if you wanted to do something like this, if you didn't want to get in there and trade all day, and Andreas, that seems like something you might be interested in. And for any of you guys that have jobs that you're doing while you're trying to trade and you can't focus so much on the trading, then something like this would be good for you. So let me go through one time with you how to set up an alert, that alert that I told you about, how to set that up. Okay, I don't know if I have one over here. I think I do. Yeah, I do. See, this I do on a 31 range, it looks like, but I'll show you how to set it up here on 100 range. Alright, everybody ready? I'm recording this, so I'll be able to. It's being recorded twice, actually. I'm recording it, and Valerie's recording it too. So, yeah, hang on, let me show you that in just a second. Let me take a drink, and then I'll show you that. Alright. So, you're going to set the alert up. It's going to be a price alert. Now, let me explain that. here it is. There's different kinds of alerts, right? The different level of trading view that you get, you have different number of alerts that you can get. If you have the basic, the free version, you get like 1 alert. That's not going to help you at all. But if you have the essential, you get 20. And if you have the plus, you get 100. If you have the premium, you get 400. All right. And I know those seem like big numbers, but they're not really when you think about everything that you can do with this. And as we keep going forward and building out things that I want to build out, then you're going to see that 100 price alerts is not that strange. There's another thing that I have to point out that makes the premium, that little extra for the premium, have some value, and this is just going to be to those of you people who plan on trading for a long time, which hopefully is all of you. But anyway, the number of price alerts and the number of technical alerts. You see, you get 20 of each with the essential, you get 100 of each with this, and you get 400 of each with this. The difference between those is the technical alerts are alerts that are triggered from an indicator. Alright, they're triggered from code within an indicator. Price alerts are like if I just come here and I say I want to make an alert, price condition, price is crossing some number, like I'll say price crossing 2020. We'll say once per bar close, and we'll make this number 20,220. I'm sorry, that's too many of those. 020. There. I want to make that the alert. Okay, and I just hit create, and I want notification. I want to send a message over here. I want to send one to the app on my phone, and I want to play a sound in my headset. I hit create. All right, when I do this, it is going to create this thing. Hang on a sec. Okay. Alright. Sorry, I just had the strangest thing just happened. Anyway, let's go back into the alerts. So, when you set the alert up, did I hit create on that? Let me just come over here and see if I did. Okay, I did hit create. Alright, so we're on the 100 range. It's 100 range, and you can go in here and change it around if you want to. But it's going to say once per bar close. So when it does go over that level right there, this is a price alert. When price goes over that level, it's going to trigger something. Alright. Now, what I'm going to show you how to do down here is a technical alert. Alright, and the technical alert means you click on the alert and you choose something other than price. Alright, this makes it a technical alert. So I'm going to choose the TV Trades range trigger. And you guys watch this because this is important. Now, the numbers down here are the same no matter what you're trading on. They're 85 and minus 85 are the numbers that you care about. Okay, 85 the upside and minus 85 the downside. So the thing that you want to be notified of, you want to be notified when it goes into the oversold, because you know when it goes into the oversold, you're going to start looking for the opportunity to go long. Because when it pops out of the oversold is what's important, right? You guys follow me on that? Nobody's giving me a yes. Okay, thank you. Alright. Alright, so good. I got a couple of yeses. One whose native language is English and one who's not. That's good. Alright. So what you're going to do in here is you want it to trigger you when you get into the oversold. So you want to know when it's crossing down, value, minus 85. You want to do once per bar close, and then down here you don't need to have all this right here. You can just do it's got the symbol in there for you already, so the symbol and the time frame. MSNQ 100, you can just do minus 85. Okay, something like that. Or you can change it around so it actually looks better. You know, you do like 100R in Q minus 85, something like that. Right now, come in here, set your notifications so they're right. Now it's going to save whatever you set in here, so the next time you create an alert, it's going to set it up automatically for you. But right now we have the same as it was on the last one. You do once per bar close and you hit create. All right. So now whenever the 100 range NQ goes into the oversold, it's going to pop up an alert and tell me. I just created it right here. Right now, one thing that I got to show you, what I was saying a minute ago about the different levels in here, the plus, the premium, and the essential. The one thing that the premium does is it gives you non-expiring alerts. I can have open-ended alerts, but the other ones, they have an expiration date. They have a 30-day expiration date. So if you do end up creating a whole bunch of them, like if you do it on stocks, you'll never have to change it for a stock. Well, you never have to change it for anything really. But if you do a whole bunch of them, and let's say you have 50 different stocks that you want to do, you don't want to have to update every month when it expires. That's one benefit of having the premium. You get an open-ended alert. But so we have this one right now, right? This is the alert we just created right here, the minus 85. Okay. So if we wanted to create another one right now for the other side of it, we go to alert and you do the same thing. You come in here, TV trades range trigger, crossing above, crossing up, value of 85, once per bar close, and in here put all the same stuff. Plus 85. How did I word that before? That last one. 100 range. 100 range NQ plus 85. Okay. So the value is 85, crossing up once per bar close, and that's it. So I'll hit create on this, and now I'll get an alert that pops up whenever it goes above there or below there. I'll get an alert. Let me know. It's not an actual trade alert yet. All right. I still have it at minus 25. Did I have this one at minus 25? That's at 85. Is this one at minus 25? Yeah, I did. Thank you. Minus 85. All right. That's how you change it, by the way. You just got to go over here and change it. You can actually pause it over here if you want to as well. Okay, and this is how you delete it. Just click on it right there. Okay, thanks, Ronnie. Look at you, so alert. Anyway, so what you're anticipating here is when this crosses above there. If that's why you have to come and look at it. Like right now, when it crosses above there, it's meaningless. It's meaningless, right? Because we're not in a downtrend. The ribbon's not spread out down. But when it does do that, if it does do that, you'll see that there's plenty of time between that happening and the next bar closing. If you use the once per bar close, does it trigger on every bar until you cancel the alert, or until it reaches the opposite side of the range trigger? It triggers every time it crosses. Okay, it's not looking at anything in here. It's going to say every time it crosses this. I said cross up, so every time it crosses up, it's going to trigger. I said cross down, so every time it crosses down, it's going to trigger. It's not looking at anything else here on price. It doesn't have that built into it. Here we go. Okay, did that answer your question? It's like right here, when this bar closes up, it's probably going to trigger it because this is going to go up and cross up above if this bar does close up, and it probably will. You'll be able to see the whole thing. It's going to trigger a little thing over here. You'll hear something in my headset. You might hear something in my headset, and I'll get something on my phone if I have it turned on my phone. There it is. So there it is right there, and there it was in my headset, and it didn't trigger on my phone, so I mustn't have it turned on my phone. But that was the whole thing right there. Okay, the whole thing. Now, if we were looking to go short, if this were bearish and we were looking to go short, well, that would be important to us right now. But right now, because it's because the one to be watching for on the long side was back here. When it got down in the oversold, this was the one to be watching for, the up close. This one doesn't mean anything, but you see how it just worked, right? The whole thing just worked right there. Alright, does that make sense? So the TV trades range trigger is a pretty powerful thing. It gives great entries almost all the time, coupled with the ribbon like this. I mean, we really haven't had anything better or easier, or that's going to give us more frequent successful trades. without you having to do a whole lot of thinking and analysis on your own. This is just, like the up close right here is where you would have been thinking to go long when it came out of the oversold. And, I don't know, you can argue with yourself about whether you could see 4 lines in there or not. But fully anticipating that we get back up to the weekly trading zone right there. Well, like the up close over here, it was easy and obvious. Is this right here, you can see all 4 lines in the ribbon. This right here, you can see all 4 lines in the ribbon. Those are the easy and obvious ones. And if you just wait for the easy and obvious ones, that's all you need. Now, one of the things that I was talking about yesterday, I don't know if you guys remember I mentioned this yesterday, or if you were in here yesterday, was this. You see how right here it's all bunched up? So you can't see all 4 lines in the ribbon because you're visually limited because it's all 4 lines. The lines are all bunched up. Now, I'm wearing glasses. I wear reading glasses, and so my vision's even more limited than some people's. But when it came out of the oversold right here, it doesn't look like you can see all 4 lines right there, right? It looks like it's all bunched up, and I'd say hey, it's all bunched up. You don't want to do anything. But if you actually look at the values over here, right here. Let me slide this over here so you're looking closer to the values. Okay, there. So right here, I want to do it like that so it stays on. No, every time I go off it changes. All right, so the value right there, you see the top one is 5104. Hang on, well the top one is the ribbon, so it should go from the bottom. If you go from the bottom, which is the black line, up. So it's 5266 is bigger than 5257, is bigger than 5165, is bigger than 5104. So the lines are spread. Actually here, numerically, the lines are actually spread right here. But it's not really much of a trend. Okay? So using the literal sense of the lines being spread, they are spread here. If you wanted to use the literal sense, that's something that you could consider. But the reason I'm saying this is because I could build something that says when the lines are all spread, so they are actually spread in the right direction, then I could make the background like red. And if the lines are all spread in the other direction, I could make the background blue or green or something like that. So it would be even more obvious to you that it's okay to take the trade. But you get into something like this one right here, where if you go from the BB, now we're going from the top down, 3.61 to 3.4 to 0.89 to 7.11. It still looks like they're spread right here, and numerically they are still spread. But I mean, to me, I would say that the lines it's kind of bunched up. That's why when I said a minute ago, you could argue with yourself about this, whether this was a valid trade or not. Because if you look at the numbers, it's 3.61, 3.4, 0.89, and then 7.11. So you still have all 4 lines spread right there. You just can't see it with the naked eye. If you go to the next one over, this one right here, they're not the right way. See, the ribbon is at 2.31, and the one right below that is at 2.85. Right there, they're not. So, I mean, it might be easier for me to make a no trade zone based on this information. You see what I mean? But you're going to be taking trades in a bunch of choppy places like this in here, and where you're going to have to really look closely to determine the prior swing high or low and all that. The easy and obvious, there's plenty to be made with just the easy and obvious. Okay, there's plenty to be made with just the easy and obvious. That's exactly it, Rico. Is it really in a trend? If the ribbon's spread out numerically, but it looks like this, is it really in a trend? The easy and obvious is when you can see the prior swing high. Step one in the trade rules. All right. There are going to be times where the ribbon is spread out the right way where this is not true. There'll be a lot of times where the ribbon is spread out the right way where that is not true, and that is step one. All right, that makes everything easy and obvious. What Rico has said is, I could build something like that, but you can't really tell if you're in a trend by that. Okay. I'm going to pause the recording right here. Alright, so I guess I'm going to end the recording right here. Alright, let me hit stop recording on this.